Thank you, friends, for tuning in once again. I'm your host, none other than Mr. Spotter Fred. Now, today, remember this session, we are following up from what we have been doing in the previous sessions. And today, we are still building up on the topic number 3 as far as advanced financial reporting is concerned. Remember, we are saying advanced financial reporting. We are looking at topic 3, and this is in respect to assets and liabilities. Assets and liabilities. Now, remember, we have been doing in the previous sessions, we started with the assets held for sale. Assets held for sale, that is IFRS 5, and this we have already done it, remember. And B, we talked about impairment of assets. Impairment of assets. Don't forget, friends, we have done this IAS 36. That one, we have also done that. Then C, we also looked at, there is exploration. There is exploration, and evaluation of minerals, This is IFRS 6. We have already done that. Then D, we talked about financial instruments. In financial instruments, friends, we talked about, this is in respect to IFRS 7, IFRS 9, IAS 32, and IAS 39. That's what we looked at. Then don't forget, we also looked at the employment benefits, no, not yet. Share-based payments. This is IFRS 2. So we have done this and this. And now we need to do employment benefits. Employment benefits. In employment benefits, this is in respect to IAS 19. So then we also look at accounting for taxes. Accounting for taxes. This is IAS 12. Now, these are the 2 items we have not done. Now, today's session, we want to look at IAS 19. That's employment benefits. That's what we want to start with today. So, employment benefits. Employment benefits. Accounting for employment benefits. IAS 19. Fine. This is the position. Now, fine. Remember, when in respect to IAS 19, we are very much interested to know how much amount to be recognized as an expense in our statement of profit or loss, and how much is the amount to be reported as an asset or liability in the statement of financial position. When we talk of employment benefits, we are looking at from the pension point of view. When employees have been working in an organization, it comes at a point when they have to retire, when they have to be paid some reward for what they have been doing. Apart from that, we have also other types of employment benefits. We have types of employment benefits, and that's mainly what we'll be looking at. One, we have the short-term employment benefits. Short-term, let me say that, we have types of employment benefits. We have the short-term employment benefits. Short-term employment benefits. Now, in short-term employment benefits, these are those benefits that will fall due within 12 months. E.g., we can say e.g., salaries and wages, leave pay, and what have you, etc. Those that will fall due within the 12 months. Then we also have number 2, we have the long-term employment benefits. Long-term employment benefits. In fact, this one we call them other long-term employment benefits because we have the main long-term employment benefit known as post-employment Post-employment benefits. Post-employment benefits. Post-employment benefits is a long-term employment benefit. That we can say that this is other long-term employment benefits. We may have other transactions other than the post-employment benefits. And finally, we have the termination. We have the termination benefits. Termination benefits. Termination benefits. When it comes to short-term employment benefits, you're saying that there are those that fall within the 12 months. When you talk about other long-term employment benefits, is any other employment benefit that does not fall as a post-employment benefit. Post-employment benefit are those benefits that or rewards that you're going to receive after retirement, after you have worked for an organization for more than maybe 10, 20, 30 years, you have retired now, you will be given post-employment benefits. Now, these post-employment benefits will be the main item that we're going to discuss in respect to employment benefits. We have termination benefits. This is when you have the employer has terminated or has contradicted the contract that you had together. Now, you will be required to it will be required to pay you the termination benefits for going contrary to the contract that you had entered initially. So you'll be given some benefits in respect to the job that has been terminated. So termination, these other items like the short-term items like the termination benefits are very straightforward to account for. Even other long-term. The other long-term employment benefits, friends, can be something like share-based payments. The share-based payments can be a long-term employment benefit. Fine, no problem. We'll be very much interested with the post-employment benefit. I go back again. When you talk of short-term employment benefits, something like salaries, leave pay, and other expenses, other items other allowances that will fall within the 12 months. You simply expense it. You recognize it in your profit or loss as an expense, and you forget about it. If it had been paid, just expense it, and you forget about it. If it had not been paid, then apart from expensing it, you recognize it as an accrual. That's a current liability. So that's not a big problem, and we should not bother with that. Other long-term employment benefits, something like the share-based payment that we have already talked about, and we'll account for it accordingly. We'll even identify the equity option and what have you. Now, I'll come to termination benefits. Termination benefits, simple. With the termination benefits, if they had been incurred at one point in time by the employer, they will be expensed in our statement of profit or loss. And if they had not been paid, then they will be reported as a liability, as a current liability for that matter. So those three items may not have a problem. We'll want to really discuss more on the post-employment benefits. We'll want to discuss more on the post-employment benefits. Post-employment benefits, as we said, these are the benefits or rewards that you're going to receive after retirement. So rewards or benefits given to employees after retirement. Once when employees are working, they will be registered in a pension scheme. We call it a plan. They will be contributing some amount of money to the plan so that amount which has been contributed will be reinvested. Once reinvested on retirement, the investment will be given back to the employee after retirement. Now, that is a basic explanation in respect to the plans and how it operates. A good example maybe we can give, in Kenya we can give an NSSF, National Social Security Fund, which will be in charge of the pension plans for employees, and is statutory. But we may also have, as every organization or individuals, we may have our own plans, our employment schemes, our pension schemes for our own purposes to just benefit later. Now, there are two types of post-employment benefit plans. There are two types of pension plans: employment plans. One, we have defined contribution plan, and two, we have the defined benefit plan. Fine. Now, how do this plan operate? There will be a contribution that will be made by the employee and employer to the plan. Those contributions are invested. Once reinvested and on retirement, the benefit will be given to the employee. That's how they operate basically. But now when you talk of defined contribution plan, when you talk of the defined contribution plan, we should remember this. One, the contributions here, are fixed. They will not change. They will not be increased or be reduced. The amount you are contributing to NSSF is constant. The amount the employer will contribute and the amount the employee will contribute or the members will contribute is constant. But the members sometimes they can be allowed to increase at their own cost. But the employer will contribute the same amount throughout. That once that amount is contributed, it will be reinvested, and it will depend on the investment that money was put in on what you are going to receive once you retire. That means that the benefit on retirement is not fixed. You may receive more or less depending with the inflation, interest rates, and how the performance of the investment. So that's very important. The contributions that are contributed are fixed, but the benefit on retirement is not fixed. Accounting for defined contribution plan is straightforward, where you just simply adjust the contributions as an expense and you forget about it. So the employer or the firm will expense the contributions for the year, for each year. If not paid, then reported as a current liability. And that is easy like that. So that is a straightforward accounting, a very straightforward way of dealing with this defined contribution plan. And it's very straightforward, does not have any complication at all. Now, when you come to the defined benefit plan, we are looking at where the contributions are not fixed, but they are temporarily predetermined. So defined benefit plan. When it comes to the defined benefit plan, one, contributions are predetermined in advance, but not fixed. The benefit will be fixed. Now, friends, this is very interesting. Benefits are fixed. You know that in advance you are going to receive maybe 50 million on retirement, 200 million on retirement. So you are aware in advance. And now the contributions will be predetermined in such a manner that if that contribution will be reinvested, will give rise to the 200 million that was predetermined in advance. So the benefit will be fixed in advance. So you know how much you are going to earn once you retire. That's the difference. There's a big difference with the defined benefit plan and the defined contribution plan. With the defined benefit plan, you are sure of the amount you're going to receive on retirement. But with the defined contribution plan, you don't know. It will depend with the performance of the investment. Now, one of the disadvantages, so yes, we have an advantage with the defined benefit plan as an employee, but one of the disadvantages is that to the employer, at some point, you'll be required to increase the contributions in order to ensure that the defined benefit that was predetermined in advance has been achieved. If there's a shortfall, then you'll be required to increase your contributions, or you give that shortfall. If there is an excess that we have noticed there is an overfunding, you have been contributing and likely to be an overfunding, then at that point the employer will be given a contribution holiday. That means the employer will stop contributing for a while. This is what it means. We are saying in case of a shortfall, the employer will be, in fact, I may not only say in case of a shortfall, let me also say this, that apart from saying a shortfall alone, that in case of underfunding of the scheme, of the plan, let me use plan, then the employer will be required to increase the contributions. Why? So that we can have the target. Alternatively, in case of overfunded scheme, the employer will be given a contribution holiday. That is stop contributing for a while. Stop contributing for a while. Now that's interesting. Now you will see, and I know if I ask my students which plan you will choose, I know a good number will want to choose the defined benefit plan, because in the defined benefit plan they are certain. With the defined contribution plan, they are not certain, they are not sure. But I'll give you some advantages. When you are in a defined contribution plan, if you are assured of the investment your contribution has been put into, if you are sure of the portfolio in which the investments has been put in, your funding has been put in, believe you me, you'll able to get all the amount. If, for example, you thought that maybe out of the contribution you'll have maybe 20 million, then you ended up investment performed very well and it brought in 200 million, you'll be given the 200 million. But we come to the defined benefit plan. If it was 50 million, even if the portfolio performs very well, you'll only be given the 50 million or the 20 million or the fixed amount that was predetermined in advance. So you'll not be given the excess. So that's the advantage of the defined contribution plan. It's only that you're not sure of the performance. If you are sure of the performance, maybe you're going to have real estate, you're going to have good investment, you'll be assured. Maybe you're going to have offshore investments, you'll be assured of the return, and you'll better go for the defined contribution plan. But if you're not sure of how the investment, the inflation and all that is going, especially when we have political instability, then you'll go for the defined benefit plan. I know my students will say, I'll go for the defined benefit plan because I'm assured of the amount I'm going to receive on retirement. I know that if I'm going to retire at age 60, for example, I'll be having maybe 100 million in my bank, because that will be the benefit. 100 million. 100 million you really plan, because at retirement you'll have had, you have built a good house. At retirement you have you have already you have already a good car. On retirement you have already done some investments. So 100 million coming on from nowhere, 100 million. As soon as we think about that and say 100 million just coming all of a sudden, you are assured. You start planning even before you retire. 100 million. You buy a big car. Of course, if you are a brother, you'll always be interested with a big car. If you're a sister, I don't know what sisters are normally interested with so much. But I know if you're a brother, you'll always want to say, budget. You budget for a big car, 20 million. You budget to go for, you budget to go for holiday. Something like maybe you go to Somalia for like 2 years. Then you come back. You'll enjoy, you'll plan in advance. So that's the big difference between the defined benefit plan and the defined contribution plan. Now, friends, we'll want to look at some of the terminologies. That may be used in these employment benefits. Some of the terminologies are some of them we have already mentioned. One of the terms we have already said is about the employee benefits. We have said short-term employee benefits, post-employment benefits, and defined contribution plans and defined benefit plans. We have vested employee benefits. We had already said it under share-based payments. Vesting employment benefits. Vested employment benefits are employee benefits that are not conditional on future employment. We also have the present value of a defined benefit. Is an obligation is the present value without deducting and plan assets of expected future payments required to settle the obligation resulting from employee service in the current and prior periods. We also have current service costs is the increase in the present value of the defined benefit obligation resulting from employee service in the current period. There is interest costs is the increase during a period in the present value of a defined benefit obligation, which arises because the benefits are one period closer to settlement. We have the plan assets. Plan assets, friends, comprise of assets held by a long-term employee benefit fund and qualifying insurance policies. Assets held by a long-term employee benefit fund are assets that are held by an entity that is legally separate from the reporting entity, are available to be used only to pay or fund employee benefits. Fine. Now, we will want to look at some of examples. We'll want to look at an example of a defined benefit plan. We'll want to look at an example of a defined benefit plan. And maybe even before we look at an example, we may be interested to see some of the steps that we always need to use if we talk about the defined benefit plan. Remember, friends, we said we may not have a problem, so much problem with the defined contribution plan, but we want to look at the defined benefit plan. In the defined benefit plan, something very important that we'll want to look at in the defined benefit plan, accounting, determination, let me say determination of expense stroke income, and assets stroke liability from defined benefit plan to be reported to statement to the financial statements. Let me say to financial statements. So how do you determine these items? There are various steps. Step number one, we are going to use, we have to determine the actuarial. We determine the actuarial gain or loss from plan obligations, and the plan assets. That's step number one. Determine the actuarial gain stock loss from plan obligations stock assets. How do we go about this? For example, if you have, let me talk about the obligations first. If I start with the obligations, I say A, gain or actuarial gain or loss from plan obligations. If you are looking at plan obligations, I'll consider maybe 1 year. I say that this is the present value of plan obligations at the start. At the start, you'll have those items at the beginning. Then you are going to add the interest or the discount. The discount or interest will be based on the plan obligations at the beginning, the balances brought down. Then you are also going to add the past stroke current service costs. Remember, we must have said that the current service cost is the present value of the services rendered in the current year by the employees. The past service costs are the present value of the services rendered by the employees before we entered a new scheme or before we entered the pension plan. So that is what we have as a past or current service cost. So you recognize it here. Then you're going to less the benefits paid. You're going to subtract the benefits paid. Then after that, you'll get the book value. The book value of plan assets. The book value of plan assets at the end of the year. At the end of the year. You recognize that. You compare that, or you just less. You compare that, or you less the present value of plan obligations at the end of the year. Remember, this is the present value and this is the book value, so don't forget that. We have the present value of the plan obligations, we have the book value of the plan I'm confusing this. Should not be assets, don't forget, should be plan obligations at the end of the year. So we have the present value of the plan obligations, book value of the plan obligations, and we have the present value of the plan obligations. So at the end, so you compare that, then you now determine the gain. Is it a gain or a loss? Very important here. Now, when will it be a gain? It will be a gain, for example, if the book value is more as compared to the present value. If this is a positive, then definitely that's a gain. If the book value is more than the present value, then that will be a gain. But if it's the other way around, then it will be a loss. That will be a loss. If the book value of an obligation is more than the present value of an obligation, then that difference is a gain. If it's the other way around, that the book value of an obligation is less, no, obligation is a liability. If the book value of an obligation is less as compared to the present value, then it means our obligations have increased in value, and that will be considered to be a loss. So you come and now identify for an asset. How do you get the actual gain from plan assets? So B, we look at B. B will want to get the actual gain or loss from plan assets. How do you go about this? We simply get the fair value the fair value of plan assets at the start. Then we add the expected return on assets. Then we also add the contributions by entity. We also less the benefits paid. Then we have the book value of plan assets at the end. So this is what you get there. You compare that with the fair value assets at the end. So this one, if you have, it will be a gain, an actuarial gain, or an actuarial loss. This, if the book value, this one will be the other way around. If the book value is greater than the fair value, then that means there is a loss. But if it's the other way around, it will be a gain. And the other one, the same, we are saying that it will be a loss, it will be a gain if and only if the book value is less than the fair value. But if the book value is more than the fair value, then that will be an actuarial loss. Now, after we have determined the gain or loss from plan obligations and plan assets, now our step number two is to determine the amount to be reported in the financial statements. Amounts to be reported in the financial statements. A, we have amount pension expenses in the profit or loss. In the profit or loss. We are going to identify the current service cost. The current service cost, that is an expense. This expense can be recognized as an admin expense, unless you're told otherwise. We also have, apart from the current service cost, we have the interest. The interest stock discount. This one will be, this is a finance cost. Finance cost. This is an admin. This is an admin, like remuneration expense. Then we also have expected return. We have expected return on assets. Remember, this is an income. So it can be, if you are to get the net, that is okay, that will be an income. Then we have this. We also have another item because of space. We have item B, other comprehensive income. Other comprehensive income. In the other comprehensive income, we are going to recognize the actuarial gain or loss on plan obligations, stroke plan assets. So it's good to always offset and determine the net figure. It can be a gain or it can be a loss under other comprehensive income. Then we also look at another item, statement of financial position. What we report in the statement of financial position? We simply bring in the present value of plan obligations, at the end of the year. Then we are going to less fair value of plan assets, fair value of plan assets at the end of the year. So you'll have the net pension liability. So that is simply what you should do in a defined benefit plan. Initially, at some point before the creation of the standard, we also used to have the cumulative and recognized gain. The cumulative and recognized actuarial gain, and it means we have to do what we refer to corridor limit. The corridor limit approach is not now a requirement by the standard. It's not a requirement by the standard. So that's why we have not gone to other steps of the corridor limit. So corridor limit is not a must. It's not a must requirement with the standard. So that's the position. So friends, after we have done this now, we'll want to look at a question. We'll want to look at a question, an illustration that must have been done some years ago. And I can see it here. We have a question. This must have been done in June 2012. In June 2012, that is a very good question. Question 3B, June 2012. We can use that one to revise. Can use this one to revise. And it has 3 years. Fine, that's okay. So I read here. It goes, ZK Limited operates a defined benefit pension plan. The following financial data relates to the scheme for the past 3 years, ended 30th April 2012. We have the year ended 30th April, discount rate at the beginning of the year, expected rate of return on plan assets. We have the current service costs, benefits paid, contribution paid, present value of obligations as of 30th April, fair value of plan assets as of 30th April. The present value of obligations and their fair value of plan assets were both 1,000 million shillings at 1st May 2009. The company reports on all actuarial gains and losses arising in the year directly in the retained profits. Required. The actuarial gains stock losses for each of the years ended 30th April 2010, 2011, 2012. The income statement expense for each of the years ended 30th April 2010, 2011, 2012. And the asset stock liability to be reported in the statement of financial position as of 30th April 2010. That's important to know. This item has not been directly been identified. So we can say that we are going to do a profit or loss and other comprehensive income so that we recognize this item under profit or loss and other comprehensive income. That's interesting. So we have no problem. If you look at the required from Roman 1 is a step number 1. Roman 2 is a step number 2. And Roman 3 is also step number 2B. That is very interesting. Now, without wasting time, you can see we have the interest discount, the expected return, we have the current service cost, and all those will be used very perfectly. Now, I'll go directly and deal with those items. Let me start with them. I can start from directly right here. I say we are looking at June 2012, question 3B. So we answer the first one. Roman 1, we are looking for the actuarial gain, stock losses on plan. Let me start with the plan obligations. So how many years are those? There is 2010, there is 2011, and there is 2012. These figures are in millions. These figures are in millions. These figures are in millions. So we start saying the present value of plan obligations as at 1st April, it must be 1st May, it must be 1st May at the beginning, 1st May 2010. Then we also have, we add current. Before the current, I have the discount cost. Then I add the current service costs. Then we are going to less benefits paid. So that's what we are going to do, These are the items we are going to do. Then we get the book value. Then finally, we less the present value of plan obligations. So this will be the end here. We'll get the gain or loss. Fine. At the beginning, from 2010, we recognize the present value of the plan obligations, which were given as a paragraph that the present value of obligations and fair value of the plan assets was the same. So it was 1,000 million. Then we have been told that the discount for 2010 is 10%. So 10% on 1,000 is definitely 100. Then we have been given the current service costs of 130. Then the benefits that are paid, we have the benefits paid there as 90. The benefits paid is 150, sorry. Then we also have the present value of the plan obligations at the end of the year, 30th April, is 1,100. Not 1,100, is 11. Yeah, it's 1,100, I'm correct. Fine. So that's it. Now let me take my calculator so that I'll be able to calculate those figures. I'll come and say 1,000 plus 100 plus 130 minus 150. So up to that point, I'm getting 1080. Remember, that is an obligation. Book value is 1080, but the present value is 1,100. So the present value is more than the book value. That's a loss, That's a loss. So a loss of how much? A loss of 20. So that is a loss. So that is a loss of 20. Is a loss of 20. That is a loss of 20. Let me show it as a loss. Then we come to 2011. We do the same story. 2011, the balances brought down in 2011 are the balances carried down in 2010. So this is 1,100. Then we have the interest would be 9%. The discount would be 9%. So I take 9%. 9% of 1,100. I'm getting 99. That's like close to 100. Then we also have the current service costs. Current service costs. The current service cost for these 2011 is 140. Then we have the payments made 180. Then we have the present value is 1380. I do the same for 2012. This 1380. The interest is at 8%, as you can see. So I take 8%, I multiply the 1380. So I'm getting 110. Let me just have it as 110. Then the benefits we are paying, or the current service cost first and foremost, is 150. Then the benefits we are paying is 190. But the present value of plan obligations at the end is 1408. Now let me take my calculator here and say 1100 plus 99 plus 140 minus 180. So that's 1159. The other one is 1380 plus 110 plus 150 minus 190. That is 1450. Now let's compare them. You come and realize that in 2011, the book value of the obligations is 1159 as compared to the present value 1380. So our liabilities have increased. By how much? By 221. That's a loss. Then we move on to the other one. We are saying 1450. And it has reduced 1408. So this one I've reduced. This is again. So 42 is a gain, but the others 20 and 221 are losses. That is for obligations. Let's also look at for plan assets. Let's look at plan assets. How do we get the actuarial? The actuarial gain, stock loss on plan assets. So we have the 2010, we have the 2011, we have the 2012. So you know that we need to start with the fair value, of plan assets at the start. Then we also add expected return. On assets, on plan assets. Then we are going to add the contributions. Then we are going to subtract the benefits paid. Then we have the book value. The book value of plan assets. Then we less the fair value of plan assets at the end of the year. Then we determine whether there is an actuarial gain or loss. So identify those figures first. I'll come and say the balance at the beginning for both obligations and the assets was 1,000 million. Then the balances, we have expected return on plan assets. Expected return on plan assets will be 12% the first year, which we have already done. No, we have not. So I take 12% of 1,000, that's 120. Then the second year will be 11%. So 11%, we don't have those figures first. Let me just recognize what we have. We have contributions. The contributions paid is 90. The benefits paid is 150. Then the fair value of the plan assets at the end is 1190. Then this 1190 will start here. And we'll also have the contributions which have been paid is 100. We have the benefits which have been paid is 180. The same. Then we also have The present value, the fair value of the plan assets at the end, 1372. Then this 1372 is what we are going to bring in here. Then we are talking about the contributions, which is 110. Then we have the expected return on plans. We are going to calculate that. The benefits paid, 190. Then the obligation, the plan assets at the end fair value is 1188. Now I take my calculator and compute first the expected return, which was 11%, 11% on 1190. That comes to 131. Then 2012, it was 10%. So 10% on that is 137. Now we compute that. We have 1190 plus 131, 1190 plus 131 plus 100 minus the 180. We have the 1241. Then we also have 1372 plus 137 plus 110 minus 190. So we have 1429. 1429 minus 1188. We have 241. 1241 minus 1372. We have 131. Then we have 1060 minus 1190. This is 130. So let's look at them again. So this, the book value is 1060, but the fair value is 1190. So it means the fair value has increased, and this is a gain. While this was 1241, but it has increased to 1372. So this is also a gain. This was 1429, but the fair value has gone back to 1188. So this is a loss. That's important. Like this one, we were saying this was a loss. This one, a loss. This one was a gain. Very important. Very important. So the loss, I can put it in brackets. That's a loss. Now from there, friends, we are to do the financial statement because we have answered Roman 1. So what will be Roman 2? In Roman 2, we want to prepare to determine the pension, the net pension expense. Let me just say the statement of profit or loss and other comprehensive income. We are looking at the extract. So this is 2010, 2011, 2012. Being an extract, we are going to start with the current service costs. Current service costs. This is an admin expense. How much was it? We had the current service cost 130, 140, 130, 140, and 150. Then we have the interest, the discount. This is finance cost. This is a finance cost, and the finance cost was will bring us to 100. This is 100, 99. Then we have 110. Then we less. There is expected return. Expected return on assets, on plan assets. This is other incomes. We have it as 120. 120 is the other income, so we reduce our pension expense. Then 131. Then we have 137, like that. So that's important. So at that point, we get this point. We get the pension expense, the pension expense, the pension expense. What will be our pension expense? It is just 230 minus 120, that comes to 110. Then we have 140 plus 99 minus 131. So our pension is 108. Then we have 150 plus 110 minus 137. That is 123. Then we add other comprehensive incomes. Other comprehensive income, we have the actuarial gain or loss on plan obligation, and we have them there. We can put a note that is, there was a 20 which was a loss, there is a 221 is a loss, there is a 42 which is a gain. Then we have the actuarial. There is also an actuarial gain or loss on plan assets. For plan assets, there is a gain of 130. That's a gain. We have a gain of 131. That's a gain. We have a loss of 241. So what will be the total comprehensive? The total comprehensive income. Total comprehensive, we have 110 plus the 20 minus 130. So we are getting nil. It's nil. That's interesting. 108 plus 221 minus 131. So this is 198. Then we come to 123 plus minus 42 plus 241. That is 322. Fine. That is for the statement of profit or loss and other comprehensive income. So we'll come to the statement of financial position finally. We come to the statement of financial position. Statement of financial position, extract, or the amount to be reported as an asset or liability 2011, 2012. So we'll have the present value of plan obligations as at 30th April 2011. Then we less fair value of plan assets as at 30th April. So if it's the plan obligations, we also have 1100. This was 1100. Then we had 1380. That's the present value. We were given those values. 1408. Then we also have, those are figures in millions. These figures are in millions. Don't forget this. So fair value plan assets at the end, we have 1190, right? We have 1372. Then we have 1188. Now let's see, is it a net asset or liability? Net asset, stock liability. So we say 1100 is definitely. So 90 is an asset. Then the other one is 1380 minus 1372. This is 80 is a liability. Then 1408 minus 1188. That's now 220, a liability. So we only have one asset, 90, and the other 8 and 220 are liabilities in the respective years. Now that comes to the end of that question, but somebody can ask this question. Why is it that we are subtracting benefits paid twice? We have not subtracted them twice, but it's the coincidence of the debit and credit entries in respect to the format we are using. Now, if you go back to the plan obligations, you realize that this is, we have subtracted. But that is in another way is a debit entry. If you're making a payment as a scheme, as a pension plan, you're making a payment, you are reducing the liabilities. If you're reducing the liabilities, you are simply debiting your liability account. So this is a debit entry to reduce our liabilities. When we come to the plan assets, we have also reduced our plan assets, because when you are making a payment out, you reduce your cash balances. That means that you are reducing your plan assets. If you are reducing your plan assets, then you credit your plan assets. If you are crediting a plan assets, in other words, you are reducing your asset, because when you make a payment, you credit your cash. If you credit your cash, you are simply reducing your cash balance. So this is a credit entry, while that is a debit entry. That's simply why we are seen to be showing that there is we are subtracting twice. It's just because of the format we are using. But in our obligations, it's a debit entry, while in our plan assets, the benefits paid are credit entries. Very important to also remember that. Now, friends, we have come to the end of this session and to the end of this topic. However, we may also have details in our previous sessions, in our previous videos, and because we will always be doing revision, we'll also have revision. We'll have revision of our sessions, then definitely we'll also encounter more questions that may be challenging and we'll want to explain further than what we have done today. But I believe and strongly believe this one has been very comprehensive and very sufficient for your exams. Thank you very much. Have a nice time. Till next time.